This is not looking good actually, because the markets continue to sell. If you're seeing a bounce of around 20, 30 points, you're seeing a correction of close to around 40, 50 points actually. And that's precisely what's happened in the last few minutes. The Nifty Bank, that was struggling with a cut of around 1,000 points. Now it's down close to around 1,300 points. And big boy Reliance Industries as well. So just put the Nifty Bank index, that's moved lower. And big boy Reliance Industries as well. Yesterday, that was a flag bearer for the bulls. Today, that's under some pressure. It's down 2.5% odd. And that's why, in fact, the index is seeing some selling on that front. Mitesh Thakkar is back with us. Mitesh, it's not looking too good. Well, what are the levels you're looking at on a closing basis? We're already broken the 100 EMA. We've broken the low point of the day as well. Do you see a deeper correction? If yes, where do you see some kind of semblance in terms of support?
Nigel, I think, eventually I'm looking at much lower levels. I've talked about 16,900 and possibly 16,380, 400 zone as some kind of an area. But what can happen always is that, with the 470 point decline on a day particularly, and, if no negative news flow comes in and if the international markets are decent, I think you might get a pullback or a sharp, snapback. So I think idea is that prepare for these kind of, pullbacks to happen. But I think as long as we are not getting past 17,200, 230 again, I think maintain a negative bias. And on the stock side, I'll have a STBT on Dalmia Bharat. I think keep a stop at about, or sell on Dalmia Bharat with a stop at 1920 for targets of 1850. And BEL is a STBT with a stop at 201 half for targets of 196 half, 196 on Monday.
It's a large cut for a single day, and I think what comes out later will be important when we hear from the WHO, when we'll hear more from the scientific community as far as this variant is concerned. I mean, the most important thing, actually perhaps the most important thing when assessing what is the risk from this new variant is this: how effective are already existing vaccines against neutralizing this variant of the virus. So I think, and of course, there is also how infectious this is as compared to the Delta variant. Maybe we will hear something about that as well. So it becomes important in terms of what we hear from the scientists. Jeff Chaudhary is with us to tell us what he's making of the price action we are seeing. He's, of course, partner at RLC Ventures. Jeff, great to have you here. Thank you very much. It's been red all across. Look at the equities, look at the rates market, look at currencies. What is your sense? Will some calm return soon, or will it entirely depend on what we hear later today and perhaps over the weekend?
Yeah, I think there's a couple of things here. I think there's a sort of the tactical sort of move in the markets, today, obviously based on the variant, and we're going to get those, from time to time. We've had it a few times this year, and we're going to continue to get those variants. I think the bigger picture, which is a much more strategic picture, is very simply the end of easy money. And what does that mean? Well, that basically, it obviously starts with the Fed, tightening, inflation, all that stuff. But more importantly, how does it affect the Indian market? It basically reflects the fact that, macro funds, international funds, FII funds are basically going to bring a lot more money home, and they're going to do it, and they're going to bring it into stocks which effectively they perceive as more defensive in their market. So over the next sort of 6 to 12 months, particularly, I think money is going to flow out of India in relation to FIIs, and I think they're going to bring that money home, and they're going to be investing in more defensive type stocks as the easy liquidity, which we've talked about for a little while, is coming to an end and rates go up.
Jeff, we've been seeing some sort of signs. Foreign money has been, been pulling out on a day-to-day basis. We have been seeing quite a lot of FII selling. But what about the debate between China's underperformance and India? Do you see some money going to China, since that market has been a relative underperformer in comparison to India, valuation-wise as well, relatively more attractive?
No, I don't actually. I think there's a couple of things. I think China has its own issues and problems. I think one of the fact that I think generally foreign investors have become much more cautious in terms of putting money into China. Now, obviously, unlike India, China is a much more domestically driven market, whereas India obviously relies a lot on FII flows. But despite that, I think the Chinese authorities in particular have obviously targeted a number of high-profile individuals in China. That's obviously hurt sentiment. And I also think that the whole worldwide tightening issue, which is obviously going to be led by the Fed, will will be reflected right across the world. I mean, there's no economy, there's no market, there's no area of the world which will be immune to the fact that, inflation is going up, rates will be going up, and it'll be harder to make money from equities in that environment.
Absolutely. So for viewers watching here who can only invest here in local stocks, I mean Indian stocks, Jeff, what is your advice, really?
Well, two things. Have plenty of cash available. There has been a debate of, the market's obviously come down a bit. Is it too late to sell? Well, my advice would be it's not. I mean, obviously today's not a particularly good day, but if there's any sort of rally or bounce back or, I think that's still an opportunity to sell the market. Valuations are very high, and because of the liquidity situation, we'll get a much better opportunity in the next 3, 6, 9 months to buy the market much lower. And if you do have a portfolio in India, it's very much, I think the recovery trade, the autos, steel, that type of recovery trade is largely over now. You should be going into very high quality management, consumer and banking stocks would be my recommendation. That's basically MNCs, in particular consumer space, and in the very high quality private sector banks as well.
Sounding fairly cautious on the Indian markets. Jeff, you're taking that point on board, and even our viewers as well will appreciate that fact. But give us a few more details. The Fed and central banks across the globe, they've been flushing the markets with a lot of liquidity, and that's why we've seen a lot of these markets do well. Now, there is this fear with regard to the resurgence of COVID. What if it doesn't play out to the extent possible? Maybe, in fact, in the near term, do you see a little bit of a delay in terms of pulling back liquidity?
I think there's two issues here. I think the first thing, even though we are seeing variants, every day, and obviously we've got the African one, I think the issue is less of COVID and the fact that obviously the markets, and in particular the Fed, basically put a lot of money to basically protect economies, 18 months ago, 2 years ago. And I think that regardless of the variants that we're going to be seeing, I think the important thing is the fact that the big picture is that easy money period is essentially over. And so the problem that at the moment is that, most commentators now in that camp is that the Fed is slightly behind the curve here. And the problem is when they're behind the curve and inflation is rising rapidly, what that means is a much more aggressive rate tightening, which compared with what the markets would like. So I think, although obviously the headlines are COVID, Delta variant, various other variants, the much more bigger picture and the thing which is much more serious for markets is the fact that interest rates are going up and probably going to go up more than markets are anticipating at this point in time. Bond yield at 2%, less than 2% in the current environment is pretty ridiculous.
But Jeff, just a very quick response to this. Is that view dependent on the fact that we emerge out of COVID? I mean, tighter financial conditions, interest rates going up and that kind of thing. Because if, for example, this variant is of any concern, and it is serious as what the markets are making out of it. Maybe they're using it as an excuse, but it is what it is. Wouldn't governments and central banks very quickly, they've not even started tightening. Wouldn't timelines for tightening extend further beyond what we're looking at right now?
Yeah, it could be weeks or a month or two, but I don't think, on a 12-month view, if we're sitting here in 12 months' time, rates, I guarantee, well, not guarantee, that's probably a dangerous thing to say, but I expect interest rates to be much higher. I think if we go back 2 years, and this is a really good starting point, 2 years ago, nobody knew what COVID was, nobody knew what the impact was, and nobody knew what the devastation would be within economies. Now we're talking about it every day. Yes, obviously there's variations, and yes, we have a situation where we don't quite know how that will play out. But the big picture is that people do know what COVID is, what the impact is, and what the result of that is, and the amount of liquidity and which has flowed into the system, and the fact that interest rates have been aggressively reduced means that, again, strategically, and I'm talking 1 to 2 years, or rather than 1 to 2 days, the strategic picture, which everyone should be concerned about here in terms of where valuations are and where the markets are, is that money is going to become much tighter. That's going to affect the corporate sector. It's going to affect, obviously, the stock market and anyone who has high levels of debt.
Okay, all right. Thanks so much, Jeff, for stopping by. You gave some valid advice to all our viewers out there, whether it's with regard to raising some cash levels, focusing on quality stocks. You see some money flowing out of India, and it's time to raise some cash levels, because if you get a bigger dip, then you get a better level to enter. Good speaking to you. Thanks so much for joining in. Well, we have Deepan Mehta as well, Director at Elixir Equities. Hi, Deepan. What a time to join in. Nifty is